Good morning. Happy Friday, everyone. I've become kind of accustomed to having this class on Friday mornings, and I wake up in a great mood on Fridays because I'm teaching the class, which is good fun, but it means it's Friday. So it's like a Pavlovian reaction I'm having that, okay, Friday morning, LLL, economics, and then the weekend. So I hope you feel the same way, even it is a bit of a daunting subject. Speaking of daunting subjects, OMG. Wow, the last lecture we had, session 7, just before the fall reading break, was on the economics and the environment, of the economy and the environment. We talked about the challenges of climate change and what it was going to mean for the economy. And then look what happened this past week. I feel that we're kind of doing real-time economics in this course. Every time we talk about something, the following week, it seems to sort of dramatize it in big headlines. And that was certainly the case this week with the storm out here where I'm living in British Columbia and all the implications of it. So I'm just going to take a couple of minutes at the beginning here today and talk about, wow, what do we learn from this as just an example of the blowback on the economy of how we've been treating the environment. So I'm sure you've been following the headlines in the news, and Ian Hannah-Mansing standing in the flooded highway. He's really good, isn't he? Giving the reports on CBC. What we had was this so-called atmospheric river, which is a phenomena that occurs when a cold front and a warmer front squish a band of air, moisture-laden air in between them, and then it starts flowing in a concentrated way. And this phenomena is not new. It's something that happens from time to time in south of the border. They call it the Pineapple Express, which brings warm, rainy weather from Hawaii across. But the intensity and size of it has changed because the energy that is captured in the atmosphere by climate change, by global warming, warm air can hold a lot more moisture than cold air, which means that the force of the flow and the amount of moisture that it's covers has increased. And there's no doubt that these storms are more frequent and more intense because of climate change, and that just resulted in this unbelievable biblical proportions downpour that lasted for 2 straight days. I'm based in Vancouver, and it rained a lot. It was something I've never seen before, that heavy of a rain. But further up into the mountains, when it starts to the air starts to rise over the mountains, and then it drops that moisture, it was absolutely unprecedented. So look at Hope, British Columbia. Some of you may have driven through Hope because it's a place that the 3 cross-mountain highways all meet. So whatever road you took, you drive through Hope. 295 millimeters of rain in 48 hours. And it just caused catastrophes over a very, very wide area as well. And all kinds of things, including obviously mudslides, floods, huge damage to infrastructure. So this is part of the Coquihalla Highway. Some of you may have driven over this at some point. It's a very modern, divided 4-lane or 6-lane highway, and this has happened in about 10 places on the highway. So this isn't something that's going to be repaired overnight. It is going to take months and billions of dollars to fix the infrastructure and get the supply chains going. And all 3 of the highways between Vancouver area and the rest of Canada have been blocked. In fact, there's 4, because you can take this very indirect route up through Whistler and then loop around, but that one's blocked too. So anyways, it's going to cause just incredible disruption, and we're only just seeing the beginning of it in the grocery stores and everywhere else with what's going on. And the economists think this was probably the most expensive natural disaster in Canadian history. It's going to cost billions of dollars to rebuild, obviously, all of that damaged infrastructure, and then the indirect impacts on the economy. So, I'm not of those who look at this disaster and almost say, see, we told you climate change was a problem. Of course, climate change is a problem, and there's just tremendous hardship and suffering that's resulting from this. What this is a lesson in terms of how big of a problem it is, how it's going to become a regular challenge for our economy, and what the implications are going to be. One of them, obviously, is to get more serious and more effective in making our own contributions to reducing climate climate change through our greenhouse gas pollution, for sure. That's part of it, but it is a global problem. So in a way, this would have happened even if Canada alone had been doing a much better job. So first of all, there has to be a global solution. Secondly, we have to prepare. Part of it is still trying to prevent as much climate change as we can, but part of it is going to be preparing for the climate change that we know is coming. We already knew that the costs of severe weather were growing. The Insurance Bureau of Canada recently released a new report saying that the average costs to them of weather-related insurance claims has quadrupled over the last decade, and it's going to go up a lot more with this one. And then there's all other kinds of economic costs from these severe weather events. Let alone the global ones that we talked about in our last lecture, particularly disruption of people who live near the sea level that's rising. That's going to be a huge one as well. On the other hand, I don't want to sound Pollyanna-ish or little Mr. Cheerful here. There are going to be economic benefits from the investments that have to be made. So rebuilding all of those highways and then taking other proactive measures to strengthen our infrastructure could lead to stronger economic conditions, no doubt about it. Certainly if you're a construction worker, and probably other types of related jobs as well. I think there's a bit of an analogy to Canada's initial post-war recovery after World War II. We built the Trans-Canada Highway, we built the St. Lawrence Seaway, we built all other kinds of important physical infrastructure that contributed to Canada's very strong economic growth during that period. We're going to have to rebuild the Trans-Canada Highway and mostly invest in all other kinds of infrastructure that is stronger and more able to survive severe events like the one that we just saw. So real-time economics. Every time we talk about a topic, we seem to live it the next week. So then I'm thinking, okay, we're going to talk about the financial markets today and the ups and downs and the hissy fits and the mood swings that drive the stock market and the derivatives market. So on that experience, I expect there to be a global financial meltdown sometime in the next week, and we'll talk about it at the beginning of next lecture. I hope not. There's only so much we can take in a couple of years. COVID, floods, droughts, heat waves, forest fires, locusts soon, and a global financial meltdown on top, not doable. Okay. Alrighty, so for today's topic, we're going to talk about the financial economy. We've been trying to understand the economy and economics as a real phenomenon of people doing work. I've said that over and over again, and I will again. The economy is the sum total of our productive human labor, our brains and our brawn, and the goods and services that we produce, and then the decisions that we make about how we distribute that output and what we do with it. And that's what I call the real economy. On the other hand, what tends to get more attention, and certainly the headlines from the daily market updates, is what I call the paper economy. That is to say, the financial blanket or curtain, if you like, that overlays the real economy where people are working. And where things are not measured in terms of work and actual output, they tend to be measured in dollars and valuations. And what is the link between the two, and how do we make sense of the paper economy and what it is and what it isn't? So we're going to talk about, we'll introduce the idea of money and prices. We'll talk a little bit about inflation, its causes and consequences. We're going to talk about the banking industry. This is very important. We have a system where the banks are mostly privately owned businesses that do their business just like any other private business, namely trying to make a profit. It's just in banking, it's a little easier to make a profit because your business, as we'll see, is creating money. Central banks is the bank that's owned by the government, the federal government, and it sets interest rates and it plays a certain role. And we'll talk about that and the policy that goes along with that. That's called monetary policy. We'll talk about corporate finance and stock markets and equities and how businesses get money to pay for their investments. And we'll talk about how that has created a rather unstable or fragile overall financial system. If we have time, we'll talk a little bit about pensions and how pensions work in Canada and whether that depends on the stock markets or not. There's a bunch of the terms, a whole bunch of them in this case, because the financial sector has its own language. So those are terms that are defined in the online glossary that's posted at the Center for Future Work website. And I invite you to have a look at those if you have any questions on the terms that we go through. So what is money anyways? We think of money as the dollars and cents that are in our wallet. I can't say I've actually got any money in my wallet. I have zero bills. Usually at this point, I hold up a $20 bill and say, this is what money we used to think of it is. But in fact, money is not by and large paper currency anymore. It's something else. In a generic sense, what we mean by money is something that you can use to buy something. Boy, it's a good thing I got a PhD in economics, that I could come up with something that profound. Widely accepted purchasing power, something that allows you to exchange the money in return for something else, another product, another service, or another asset, if you prefer. Many things have been used as money over the years. So jump into the Q&A just right now. Money, of course, as currency, or sometimes we think of it as gold, that we used to make currency out of gold, but all kinds of weird things have been used as money over the years. That is a thing that's widely accepted as purchasing power. Jump into the Q&A and just shout out a few examples. One of them that I can think of is always interesting. Cattle or salt, somebody says. Tulip bulbs, we'll talk about tulip bulbs. Shells, there's a good one. A lot of Pacific Island countries use different shells as a source of money. One Pacific Island country, I forget which one, used giant round rocks as money. Giant round rocks that they hollowed out with a hole. They weighed about half a ton each, so it was quite the thing to move them around. But they were interpreted as money. Beaver blankets and beads in indigenous societies in North America. Cigarettes, there's a good one. That's the one I was thinking about. In times when the conventional money system is broken down, people find others, and particularly I know in a wartime situation, when cigarettes were a treat for the soldiers, the use of cigarettes as a trading commodity was there. So lots of other examples there in the Q&A. Take a peek. Thank you for that. Thank you for that input. The criteria is it has to be accepted. Okay, that is to say there has to be a social acceptance of the money. Otherwise, why would you accept it? So it seems strange to accept a giant round rock with a hole in the middle as money. But if it is a social institution and a custom that is accepted, then lo and behold, it works. And how the acceptance of money over time was enforced or stabilized or strengthened was often through a government authority that imposed the rule that, yes, this is money and nothing else is money. Today, most money has no inherent value in and of itself. So those commodities that we talked about in the past, whether it was cigarettes or cows or large round rocks, they had they still did have some kind of value. The jewelry, for example, that could be made with gold was a certain inherent value in addition to its use as money. Is in generally something that was hard to come by and therefore inherently limited in supply. And it did have some kind of inherent widespread value that people could then underpin their willingness to use it as money. Today, by and large, money requires the authority of government to say that we are going to, in our society and in our economy, we're going to accept this thing as money. So a Canadian dollar, even when it's printed on currency, let alone when it doesn't have currency, when it's just an entry in an electronic account, a Canadian dollar has value because our government says it has value. That's ultimately the source of its authority. And one of the ways that the government ensures it has value is saying that's how you have to pay your taxes. Everyone pretty well has to pay taxes one way or another. And the government says, I will accept your taxes not in large round rocks or cigarettes or beads. I will accept your taxes in Canadian dollars. And this is a way that fundamentally underpins the value of the currency as a means of exchange. Now that can break down, of course, if the government falls apart or society and the economy falls apart, then that fiat authority that gives money its purchasing power and its acceptance can disappear. And that has happened and many times in many countries over history. Lots of myths about money. Money is not currency, as I said. The actual paper currency, which obviously legally anyway, can only be printed by the government, in particular by the Bank of Canada. The Bank of Canada is the institution that issues currency. And if you look on a $20 bill, you'll see the signature of the governor of the Bank of Canada on the back of it, authorizing that this is real money. But that currency itself is a very small and shrinking share of the total amount of money in our economy. And most of you understand that in your day-to-day life. You don't use very much currency, especially since the pandemic. That's why I have no currency in my wallet. I should go to the ATM, actually. I like to still have a little bit of currency in case my credit card stops working. Usually we buy stuff with a debit card or a credit card or some other digital or electronic means. And those electronic transactions are the dominant source of money. So most money is not printed currency. Most money is an electronic entry in your bank account. That could be your checking account. It could be your savings account. It could be your line of credit. It could be similar accounts that businesses and investors have. And you don't hand over a bill when you buy something, you transfer it electronically. And this, of course, is becoming even more important for health reasons, as people thought that transferring physical currency could be a source of contagion. This is the really interesting bit. If you thought of currency as money, then you know only government can create money, because unless you're running an illegal counterfeiting operation, it's only the Bank of Canada and its official printing operations that can actually create that new money. But if that isn't the by and large money, if most money is electronic entries, where does it come from? And here's the interesting bit. Most new money is created by banks, and our banking system is almost totally private companies. So private banks create new money every time they issue a loan. This is the interesting bit. So as I mentioned, the amount of money you have is not mostly the currency in your wallet, unless you're old-fashioned. Most of what you have is the electronic entry in your account. And where did that money come from? At some point, a bank issued someone a loan and just wrote on the computer, this person now has $10,000 in their checking account. That's how the loan was issued to the person who was then going to go out and spend it. And that was literally the creation of new money. Then that person went and spent their money, and it ended up somewhere else from whatever person they bought the stuff from, and so on and so forth. But the original input, the original creation of new money in that system, was private banks who decided to issue a new loan. Interestingly enough, when you pay back the loan to the bank, you actually destroy the money that was created when the bank issued you the loan. So the rise and fall of the amount of money in our society is not by and large the government printing out currency, not remotely. The rise and fall of new money in our economy is banks issuing new loans faster than people repay them. And that's what creates a growing stockpile of money. So this sounds kind of like, just a very kind of weird alchemy, if you like, that banks can just out of thin air create money. But in fact, that is exactly what they do. And there's lots of old kind of mythology about how banks collect the hard-earned savings of people who put aside, different bits of currency at home and then brought it into the bank and deposited it, and then the bank lent that money out to someone else. And that isn't remotely how it happens. The banks created it right from the beginning. So whenever a bank makes a loan, says the Bank of England, this is the central bank in the UK, it simultaneously creates a matching deposit in the borrower's bank account, thereby creating new money. That's where new money comes from. I prefer John Kenneth Galbraith's approach. John Kenneth Galbraith is a Canadian-born economist who got famous when he went to America, kind of like David Card, the economist who won the Nobel Prize this year. One of my favorite, he always had a wonderful way with words. The process by which banks create money is so simple that the mind is repelled. Like you literally just can't believe it. You think, what? The bank just entered a line in a computer and that created the new money. But as long as the money is accepted and as long as the financial system is integrated and operating, that's exactly where new money comes from. And that creates some incredible advantages in our system. It means the monetary system is very flexible and very quick to respond to things. It also creates huge problems in our system because it means that we've given private businesses a very unique authority, the power to make money. And no wonder they make money in terms of the profits of the banking system. We've given them that power. What is money used for? Economists typically identify three sort of core purposes for having money in an economy. One is this means of exchange, this idea that it's a widely accepted a widely accepted asset that you can give to someone else and get something else back for it. And that means of exchange is a way of lubricating trade and commerce in the economy. So because you have money, it means you can sell something to earn it and then spend that money to get something else. And there could be no connection between how you got the money and how you spent it. Without money, you would have to, in order to have a trade, okay, you would have to have find somebody who wanted to buy what you wanted to sell, but also had something to sell that you wanted to buy. That's a system called barter, where you're actually just directly trading one thing for another without money as the intermediary. And it's very hard to do that, just because you need to have some kind of specialized connection between somebody who had what you wanted, who also wanted what you had to sell. So money as a means of exchange is very efficient. I remember once my very first car was just a really cheap pile of junk, a red, rusty old car. And when I went to sell it, I was selling it for $250 in Calgary in the 1980s. And somebody phoned me up and said, would I take color TV in replacement for the car? He didn't have any money, but he did have a TV. And would I take the TV for the car? That was the kind of barter type arrangement. And no, I didn't need a TV. I wanted the little bit of money that I could get for the car. It also has other purposes, though. One of them is as a store of value. It's a way of keeping a certain amount of purchasing power on hand, and then it's available for when you can use it. And in theory, it shouldn't rot away. It shouldn't turn moldy. It shouldn't disappear. It sits there until you're ready to use it. And a true money has some kind of ability to last and to be set aside and to be accumulated and then spent at a later date in a more reliable way than taking physical commodities and setting them aside in order to sell down the road. If you produced something and you didn't need to, you didn't want to trade it for something else yet, but you just set it aside, it could go rusty, or it could go moldy, or it could have other things, other ways that it depreciates. Finally, money is also used as a unit of account. If the money is widely accepted and it's a stable source of value, then it's a way of measuring the value of different things, such as prices, such as the value of accumulated wealth, such as profits, such as wages. It gives you something to measure all of these different variables by. So these are the reasons why money is useful in conventional economics. So here's an interesting question. Just again, in real-time economics, let's think about something else. A big phenomena. The stock market always has its fads in the world of high finance. People who jump on something as the best thing since sliced bread. And one of them lately has been this thing called Bitcoin that some of you have followed. And Bitcoin was an idea to try and create a form of money that did not depend on government endorsement. Okay, so I mentioned most of our money today is fiat money. It's endorsed by a government which says you have to pay taxes in this money. That's what gives it its sort of foundation as a broadly accepted form of exchange and store of value and unit of account. And without that, it's hard to see what the value, why people would accept this paper in currency terms, and even more ethereal entry on a computer program in digital terms. Why would you accept it? Well, today we accept it because the government says it's money and we accept it. Therefore, that is used. But there's a group, mostly kind of right-wing libertarians. They came from a certain kind of philosophical perspective that said, no, we want to have money that doesn't depend on government, in part so that government can't interfere with us and monitor us and track it and make us pay taxes, by the way. This is what kind of spurred this idea of Bitcoin, where a bunch of computer geeks, basically, around the world. It started with a guy in Japan. Found a way to use a technology called blockchain. Blockchain programming is a very complicated computer technology that basically uses enormous computing resources to create a code that can't be broken. And it can be used for various purposes, including confidential transactions and that kind of thing. But they figured out how to use blockchain technology to create little in essence, digital coins that they call Bitcoins. That's where Bitcoin comes from. And there was an original Bitcoin, that's the most important one, but that has spawned tens of thousands of other businesses that have set up saying, we're going to do our own Bitcoin. It won't be called Bitcoin, it'll be called some other name. They've gotten different celebrities involved to try and give each individual Bitcoin a bit of profile and thereby get people to buy it. And the interesting thing is they have this process called mining, Bitcoin mining, or cyber currency is another term for these things, where thousands of computers operate day and night running these very complicated codes in order to create each new Bitcoin. And the idea is because the code can't be broken, the Bitcoin can't be copied, it can't be replicated. So then you know that there's a limit on the supply of them, depending on obviously the computing power of all these computers, and it uses enormous energy. It's one of the biggest uses of energy, frankly, in the economy now, is all these computers doing nothing useful but creating the code for these Bitcoins. And then the price of Bitcoin has been spectacularly fluctuating, depending on whether people think it's real or it's going to be a fad. So this shows the price of Bitcoin over the last basically 3 or 4 years since it was created. And it went from nothing, from a kind of a niche interest of computer geeks, into a worldwide phenomenon that now has trillions of dollars of people's real money tied up in holding Bitcoin. And the price goes up and down. It's currently selling for about $75,000 per Bitcoin. And that's close to its all-time high, up 7,400% over the last 5 years. So this is interesting. Some people have made a lot of money off of it. Some people have lost a lot of money off of it, because you see that every time the price has gone up, the prices later on come down. And it's because it depends. It doesn't have any kind of government authority behind it. It depends on people's willingness to accept it. So here's an honest question. If we think back to those 3 purposes of money: means of exchange, store of value, unit of account, is Bitcoin money? This is there's no right answer or wrong answer. This is a hotly debated topic. I have my own view on it, but take a minute here, throw your answer into the Q&A. Do you think Bitcoin is money? And would you use it? Okay, not just as an asset. Some people, most people who buy Bitcoin aren't actually getting Bitcoin in order to go out shopping with it. Most people who buy Bitcoin are buying it as a speculative asset. They think it will be worth more tomorrow than it was today. So throw your answer into the Q&A and let's see if people think Bitcoin, is it money? Got some good questions up here about banks, and we'll talk about that in a bit. Yes, it stores value. No, I wouldn't use it. Okay, that's a good economist answer. On the one hand, yes. On the other hand, no. Yes, it is money, but I would not use it. No, it's a form of investment, not a form of money. That's an interesting point. It is money, but not for me. It's too unstable and can be stolen. That's very important. It's too unstable. If something's going to be a store of value or a unit of account, and you're going to organize your whole economy around it, if it's worth $75,000 one day and $30,000 the next, that could be a big problem. Yes, it is money. No, I won't buy it. I guess it is. No and no. Only if and when Bitcoin is used to pay for real goods and services. So this is interesting. Remember Elon Musk, this self-indulgent egotist who owns Tesla cars, said, with great fanfare, we're going to allow people to buy the Tesla with Bitcoin. And it caused a giant spike in the price of Bitcoin because people were saying, yes, now we're actually going to be able to buy stuff with it. It didn't last. He changed his mind because the price is too unstable to actually run a business on. Okay, lots of good answers there. I had a column on this in the Toronto Star. Good riddance to the crypto traders, they called it. Boy, did I get a lot of hate mail for this one from all the Bitcoin enthusiasts who thought I was really challenging the true religion. I argued it can't be money because there's no government endorsement. There's no stability to its value. You can't actually buy and sell goods and services with it. One country in the world, El Salvador of all places, mostly because it's a right-wing corrupt dictator who must have been getting some money to do this. One country in the world said, we'll use Bitcoin as an official currency and you can pay taxes in it. No one else wants to do it. For the most part, it's a kind of a casino thing that's happening right now. That would be my view. But there are others who say, no, it's more serious and we have to take it more seriously. and like other things that have been used as money or as a speculative asset in the past. So there you've got Bitcoin in the corner, and other things that people have speculated on: gold, real estate. That's a big one now. This is the one on the bottom right is that painter. Who's that graffiti painter? I've forgotten his name now. Dansky or something like that in Britain. Somebody put the answer in the Q&A. You know who I'm talking about, who does the graffiti, but his pictures have become worth millions. Tulip bulbs, that's the one in the middle. In Holland, in the late 17th century, tulip bulbs became a speculative mania where people were investing in tulip bulbs not to plant them in their garden, but because these new colors that they were inventing became so fantastically popular among investors that you could make a killing buying and selling tulip bulbs. So all of these things have become assets for speculation, including Bitcoin. The only difference is the other four at least have some inherent value. You can make jewelry out of the gold, you can plant the tulips, you can hang the art on your wall. Bitcoin has no inherent value whatsoever. It's just a piece of code that used an enormous amount of computing power and energy in order to create it. Okay, there's my rant on Bitcoin. We'll see what happens to the price of Bitcoin this coming week. Now, money has a long history, and you know that you've been to the museum and you've seen old coins from other times, other points in history, and not just coins, but other forms of money that were used. And it wasn't invented under capitalism, but money took on a new importance under capitalism for some concrete reasons. First of all, remember, one of the defining features of a capitalist economy, most of the work that occurs is through private businesses that are doing it to sell a product and make money. It's no longer a question of doing work that directly meets a human need. That is still the end goal of why we work. But in capitalism, it kind of goes through this intermediary process whereby a motive to create money, to make money, make and accumulate money, namely profit, is what spurred a private company to get going, to undertake an operation, to invest capital, to hire workers, to produce something, to sell it, and then at the end of the day, hope they have money. So money has become the goal, not the means to the end, the end. Secondly, in the course of doing all of those things in a capitalist economy where most production, about 85% of our GDP, as we discussed, is undertaken by private firms to make a profit, companies actually create new money in the course of initiating production. In particular, when they go to the bank and in one way or another get lent money, finance in different forms to expand their operations. So they're actually creating money in the course of trying to make money. Finally, there is the fact that we have a banking system that itself is privately owned and run for profit. And they are the ones who have the power to create money. And they manage, by and large, the monetary system. And it has odd and sometimes chaotic and destructive effects. So for all these reasons, the role of money changed as the economy evolved into a capitalist form. And this role of private firms through the banking system creating money in order to initiate new production is a very, very important cycle. It's in economics, in heterodox economics, it's called a monetary production system, is another way of describing capitalism. So a business wants to try and make a profit. They're going to open up a new operation. They're going to have to hire workers and pay their initial wages. They're going to have to buy capital equipment and build the place of work. They're going to have to pay for the raw materials and all the other infrastructure that comes in. How do they do that? How did they get it going? Well, there's various ways. It could be that they carefully saved up all the money in order to then go down and pay for the capital equipment and the building and the initial wages. Very unlikely that happened. Nowadays, in particular, with a banking system that can create new money by issuing credit, by issuing loans, you don't have to save that money. The company can access the funds, borrow the money, and in the course of that loan, the new money is created. That money is then spent by the business to set up the operation, to build the facility, to buy the capital equipment, to pay the initial wages of the workers, to pay for the raw materials. Then the whole thing starts. Production occurs. The workers use their brains and brawn to produce the good or service in question. The business sells it. The business pays off the costs of those things, including paying back some of the loan, and hopes that there's profit at the end of the day. And then the course of that production also started so many other things that happen, including the workers getting paid and then the workers spending their money on the consumer goods and services that they need to maintain and reproduce their families. So that whole cycle gets started by that initial act of a company deciding to invest. And in a credit money system like we have, they didn't need the money in the first place. They just have to go to the banking system and show that they had a business case that makes sense, and hope that through one means or another, and we'll talk about some of the different forms that it can take, they're able to get the capital and the finance to start that whole process. So I just, again, want to reinforce this distinction between the real economy, where we're producing goods and services, and the paper economy, which is the dollars and cents and financial assets that kind of represent and overlay that real economy. And that distinction applies to the issue of capital as well. We often think of capital as being a large amount of money. And a capitalist is someone who has a large amount of money that they invest in the economy. In the real sense, we've talked about this earlier on. Capital is just a fancy word for tools. Tools and all of the other tangible goods and even intangible things like computer code and recipes for pharmaceuticals. They're the tools that we use in order to produce the goods and services that we are working on. And because we use more real capital and more sophisticated capital in our work, we're way more productive and way more effective in our work than we used to be. In a general sense, anything that you've produced, that you've worked on, not to directly consume, but in order to produce something else, is a tool or a form of capital. And that's what we mean in the real economic sense. In the financial sense, it has been, the word has been kind of usurped, if you like, and is used in a way to refer to the financial values that are associated with real capital. And so finance or financial capital just refers to the money that in theory should be used to buy all those tools and equipment and set up the business and get the whole thing operating. So I prefer not to use the term capital when I'm referring to finance, because I think it gets confusing. I prefer to limit the use of the term capital to the real tools, the real equipment, the real machinery, the real intellectual capital that was accumulated in order to facilitate production. Finance is the monetary overlay of that. Finance can come in all kinds of different ways, and the more sophisticated and creative the financial system becomes, the more different ways there are for businesses to go out and get that initial money and start production. The simplest is just through a good old-fashioned loan, where you go to the bank, you present your business case, you say, I want to start this business, I think it's got a good shot, can you lend me the money? Simple. The bank then evaluates your plan. The bank also monitors you. There's like an ongoing relationship with the bank. The bank doesn't just give you the money and say good luck. The banker is going to come by and see the business and make sure that you're using the money in the way that you said it was going to be used, and then you can repay it over time with interest. And the bank takes a certain amount of interest depending on what the risk of the business is and depending on what the overall level of interest rates are. Simple. On the other hand, the entrepreneur, the actual business person, doesn't like being under the thumb of the banker and being at the banker's whims. And sometimes it can be more expensive to access money this way. So there's lots of other ways that the business community can raise finance to pay for those operations. One of them is a bond, where a company issues a piece of paper that's basically an IOU. And the bond says, okay, I'm going to repay you this money on this such and such a date with interest. That's what a bond is. It literally in the olden days was a piece of paper with fancy embossing and lovely type. And nowadays, again, it's usually represented digitally, not on paper. What this does is it cuts out the bank as the intermediary and allows the company to go directly to someone who's a financial investor who has money that came from somewhere. This is the key point. Where did that money came from? It was still ultimately created when the banks issued the loans. But if somebody has a stock of money, a wealthy person who wants to invest, this is another way that you can invest in a company by buying their bond and eliminating the banker. On the other hand, you've created a new middleman, because usually It's not going to be like me selling my car, finding a guy who wanted to trade me the TV. Okay. Usually you don't know the individual who wants to buy your bond. You have to go through a broker. So there's a new middleman, the bond broker, who helps to facilitate this trade. And guess what? The banks did. When the banks saw this happening, the banks went into the brokerage business. So, and the government allowed them. There used to be rules limiting what banks could do, but the banks saw there was a lot of money happening in the bond trading business, and they set up their own brokerages, or they bought the brokerages that had already been created. So the new middleman is pretty much the same as the old middleman. Another interesting difference with bonds, it's a piece of paper now, not a relationship. And you can actually buy and sell that piece of paper to someone else. So if you lent the money to the company, and you got the IOU, which was the bond. It might not pay you back for 5 years or 10 years or even longer, but it might be that for some reason you want the money now. All you have to do now is find someone else who buys the bond from you, and they will do it if they think the business is stable and is going to repay you. And they might also make some judgments based on how the prices of the bonds themselves are going to go up and down. So all of a sudden, you've securitized this loan. And there's now another game in town, which is the casino, where you buy and sell bonds. You're no longer really directly involved in the real operation. You're now looking at the changes in price of bonds and whether you can make money buying or selling bonds. Big change because of that securitization. And the bond market is now worth trillions of dollars every year, well, trillions a day globally, of buying and selling these pieces of paper, most of which have nothing to do anymore with the company that actually borrowed the money in the first place. Then you can go to another level of securitization by issuing shares. A share is where you have a piece of paper or a digital version of it now, which says you own a little piece of the company that you're lending money to. And as an owner, you have different rights. You have a right to the profits, a share of the profits down the road. You also have rights in governance, that is to say, to vote for who the CEO and the directors are going to be. Anyone who's been following the saga of the Rogers company understands the ins and outs of corporate governance. This is the Canadian telephone giant where there's a family feud over which Rogers gets to be in charge. So the idea of shares, again, is you're giving the money to a company to help them invest it. It's no longer a loan that they can repay. You now have an ongoing stake in the ownership of the company. You'll get profits from it, but you also conceivably take on more of the risk involved, because if the company goes broke, you now have no claim on it. Whereas if it's a loan, the company is still supposed to repay you. If it's broke, it's still probably not going to repay you. But in theory, it's a higher level of risk on you, but potentially for a higher level of reward. And you've created a whole new market. This is where the stock market came from. People buying and selling those pieces of paper that say, I own a little piece of this company. And when you buy a share on the company, when you buy a share of a company on the stock market today, almost never are you actually giving the money to that company, okay? Only if it's what's called a new issue, where the company is selling new stock into the market, are they actually getting any money. Mostly, 99% of what goes on in the stock market is buying and selling shares that have already been issued. And this is important because people think if I own the shares of a company, I'm somehow endorsing it or rewarding it. And you've seen the rise of folks who want to make sure they aren't owning the shares of companies that are unethical or high polluting companies or whatever. And they think, I'm going to sleep well tonight because I sold their shares. It didn't actually mean anything to the company directly that you sold its shares because you just sold the share to someone else who now owns the piece of paper instead of you, and had no direct impact on the company. That's just the beginning. Stocks and bonds are just the beginning. And you have got some of the smartest, best paid people in the world sitting down there on Bay Street and Wall Street and the city in London and the other financial centers of the world developing more and more expensive, complicated, exotic ways to lend money to companies, most of which then involve a subsequent game of what do you get to buy and sell as a financial asset rather than the actual act, the initial act of lending the money to the company in the first place. So you have a monetary production system in our economy, in capitalism, where a private company undertakes production to produce a good or service and sell it. And in order to get that going, they've gone to the banking and financial system to get that money in the first place. What are the implications of this? Number one, investment can respond really quickly. This is one of the reasons that modern capitalism is an incredibly flexible and dynamic system, despite all of its flaws and problems. You don't have to have carefully saved up your pennies for decades in order to undertake a new investment. If you've got a really good idea, you can go to the financial sector, whether it's a bank, bond traders, equity brokers, or some other even more exotic place, to say, this is a great business plan I have, and lend me the money and let's go for it. And depending on the way the financial institutions work and what regulations they're required to follow and so on, the money can be raised very quickly. And this is one of the ways that you see fantastically rapid change in certain sectors of the economy. Silicon Valley is a very good example, where you have companies that are dependent on some new idea, some entrepreneur. Sometimes they were, well-established, rich business people. Elon Musk, the Tesla guy, did not come out of thin air. He didn't just sort of wake up one day and have a good idea and say, I'm going to build cars. He came from a very rich white Afrikaans family in South Africa that profited mightily from apartheid. His family owned an emerald mine. So, he was born wealthy and powerful, and then he took some of that and leveraged it into even more wealth and power. So he wasn't a quote unquote self-made billionaire. But sometimes people do come out of nowhere. The person who was tinkering with computers in their garage came up with an idea and convinced enough financiers, whether it's banks or investment bankers or brokers or just sheer speculators, to give them enough money, and sometimes it works. Those are the stories that you hear about, and it has allowed part of the economy, like Silicon Valley, to develop very quickly and very rapidly, rather than carefully saving money up in order to make an investment. Now, the person running the real business, what I would call the real capitalist, who undertook the initial investment and organizes production and sells it, now has a relationship with the financier, with the banker or version of a banker. They're both interested in making sure that this business succeeds and generates profit. And in that way, they both got a shared interest in successful capitalism, if you like, because one way or another, that business is going to have to be profitable in order to pay it back. Interestingly, that link between the profitability of a business and its ability to pay back the lenders has kind of been broken in the very highly securitized, highly financialized economy that we live in today. So you have a situation where you have a company like Uber, for example, that was based on an idea, a technological idea of using smartphones to hail taxis. Wow, okay, that's an interesting idea. It has a certain usefulness. But is it really the dramatic change in how the world works? I'm not sure. But the guy who invented it caught the interest of some initial investors who put money into the company and allowed him to get it going. And now Uber is huge, employs in quotation marks, because Uber says it doesn't employ its drivers and the people who deliver fast food. Uber says they're independent contractors who work with Uber. In fact, Uber claims Uber works for them, not the other way around. But at any rate, there's 2 million people around the world who work for Uber, driving cars and delivering fast food and doing the other jobs that are mediated through a smartphone app. The company's worth about $80 billion US on the stock market at latest check. The company has never made $1 in profit. In fact, it has lost $20 billion cumulatively, and it's still losing money, and nobody really thinks it's going to make money. So this is an interesting thing where the break between the business actually making profit and the financiers making money off of it and getting their money back creates some really interesting and weird situations. So the people who have made money off of Uber, a company that itself has never made money, were the early investors who bought the shares and then have since sold the shares onto the stock market, selling the shares to other people who think someday Uber is going to be the next Amazon, and I'll buy the shares even though the company's never made $1 profit. So really weird stuff happens when that relationship between the financial sector and the real sector gets complicated and convoluted because of these dramatic and interesting new forms of finance. On the other hand, well, both the banker or the financier and the real business person have a shared interest in profitability. They'll argue over who gets it, and they'll fight over how much of the profit should go to the financier, how much of the profit should go to the owner of the business. And another way that issue has become more complicated with a very financialized economy is the owners themselves have become financiers as well. So you see the businesses becoming more involved in financial activity rather than real production. So a company like General Electric, say, which was once one of the biggest manufacturing companies in the world, now does much more business in lending of various types and financial activity rather than actual production. And then the individuals who started these companies, like the founder of Uber, who has nothing to do with Uber anymore, he got fired, but he made billions personally off of his stake in a company that has never made a dollar in profits. This overdeveloped and incredibly innovative and incredibly creative financial system and all of these assets and forms of lending and derivatives has some benefits in terms of how flexible and dynamic the system can be. It has some drawbacks because of the distraction of people's real energy away from the actual task of production and how can we make things work better. Instead they focus on the ups and downs of paper asset values and how much money you can make on the markets rather than through actual production. So that's the kind of classic cycle of production and credit creation that links real production under capitalism with the banking system. What's been interesting is the actual business investment that is fueled through that credit creation system. In that classic cycle, businesses invest much less than they used to. And we have discussed that in an earlier class, where despite the favorable business and political and tax environment that was created under neoliberalism for private businesses, businesses are investing less, not more. And we showed you the Canadian data and we showed you the international data. So interesting point, given that real investment is stagnant, the financial system is always looking around for new ways to make money. And if the businesses themselves aren't borrowing a lot to invest, then banks will look to other places that they can use their power, their very unique power to create money out of thin air and make money off of the lending. And this is where over the last generation, we've seen a huge increase in the amount of lending that goes aimed at households and consumers rather than at productive businesses. So for the traditional banking industry, those loans to individuals and households are now more important to their profits than conventional lending to the corporate sector to finance investment. Individuals always would borrow and pay back loans at different parts of their life cycle, when they were buying a car, when they were buying a house, when they were sending their kids to university. But the scale of borrowing and the perpetuation of indebtedness among households has increased humongously. We often hear in Canada a lot of discussion about government debt being too big. Household debt is way bigger than government debt, and households are much less secure as a group of borrowers. Interest rates that households pay are much higher than the interest rates paid by governments, and households go broke. Governments don't go broke. So interesting that the banking system has, at the same time as the world of corporate finance has become more and more convoluted and innovative in all of these different forms of new lending, it has also shifted its attention to lending money to households. And some things have happened because of that. One of them is clearly the dramatic escalation in the cost of housing. In Canada and many other industrial countries, real estate, property, housing has just become fantastically expensive relative to people's incomes and their ability to pay for it. And various things are at stake there. One of them is that housing itself has become a speculative asset where people are buying houses not to live in, but in hopes that they'll resell it for a greater value at some point down the road. Secondly, the other thing that happens is it's a way of buying off workers, I would argue, whose wages have been relatively stagnant Their ability to negotiate and win higher incomes from their employers has been undermined by all of the changes that we've discussed under neoliberalism. And a way of kind of, keeping them silent, if you like, is to say, well, your wages won't have gone up, but we've deregulated banking. It's easier for you to get credit, and you can finance a higher standard of living than your income actually affords. So for both reasons, political and economic, this shift towards more indebtedness among average consumers has had important changes as well, and important risks because, again, particularly for individual households, they're a riskier proposition than other groups that could be lent to. So just a little bit more on the paper economy versus the real economy and what it means for inflation. Let's just take the last couple minutes. I won't get through the whole lecture today, unfortunately. There's just so much to talk about in the world of finance and money and so on. One of the dimensions of money and monetary policy is how we understand inflation. Remember, the economy, we've said, is the sum total of the work that we do to produce goods and services. And in real terms, we're measuring the actual amount of that output. However, in the formal economy, all those goods and services have a price of some kind. So what we called nominal GDP, measured in actual current dollar terms, is the monetary value of all those goods and services. And early on in the class, we talked about the distinction between the growth in the economy that could be due to actually producing more goods and services, so that's what we call real growth, versus the growth in apparent GDP that happens just because everything got more expensive. And that's what inflation is. Anytime you see an overall increase in the average level of prices in the economy, that's what's called inflation. So different products have different prices. The prices could change in relative terms in that some things become relatively cheaper. Computers, for example, over time tend to become cheaper. Some other things over time tend to become more expensive, including housing, as we just talked about. So those changes in the relative price of things reflect all kinds of factors, including productivity and changes in consumer tastes and so on. But when you see all the prices for everything rising, the overall level of prices going up, this is what we call inflation. Inflation can have lots of different causes and lots of different consequences. In general, a bit of inflation is good. Most economists think it's good to have some level of inflation. They'll have some disagreement on how much is good. In Canada, we've been targeting inflation at 2% a year. This is what economists at the Bank of Canada and elsewhere have decided is good. In other countries, it's a little bit higher. Maybe even 4 or 5% is good inflation. What it does is it allows those relative price changes that I talked about to occur without forcing companies or workers to actually cut in dollar terms the amount that they're charging for something. An actual absolute reduction in prices can be a hard thing for a business or a worker to do. And so that resistance to nominal price reductions means you can achieve changes in relative prices as long as the overall level of prices is growing at a certain pace. You could just freeze your price. That would be a way of reducing its real price relative to everything else without actually having to cut the price. So for that and for some related reasons, economists think a little bit of inflation is good. Too much inflation can obviously be damaging, and many of us have heard stories of some countries at different points in history, like Germany in the Weimar Republic or Zimbabwe in the last couple of decades, where the price system broke down, where money was being created, whether through the banking system or through old-fashioned printing of currency, and prices of everything just got out of control, a thing that's called hyperinflation. That has happened from time to time. It's always accompanied with social and political breakdown, and it is exaggerated as a fear in our world. If we have a stable system of government, hyperinflation isn't going to occur. Too little inflation can be a problem. If you had zero inflation, falling prices is a big problem. That's called deflation, when the average level of prices declines over time. The Bank of Canada's goal, its marching order in our system, is to use interest rates, to adjust interest rates up or down, to hit an average target of 2%. This has been the system over the last 30 years. The Bank of Canada has had this system of inflation targeting. More often than not, they've fallen below the target. So in general, our inflation has been too low, even by the Bank of Canada's standards. They currently are above the target. So you've probably seen headlines that as the economy emerges from the pandemic, and we've had supply chain disruptions that are going to be made worse by what happened in BC, inflation has picked up, not to an astonishing level, and some economists would argue this level of inflation is actually good. At any rate, it's offsetting previous times when inflation was too low by its target. In order to try and hit the target, the theory of the Bank of Canada is, oops, there's my energy efficient lights again. Okay, I'll wave my arms. There we go. The bank increases the interest rate when they think there's too much inflation. What that does is it makes it more expensive to borrow. And by making it more expensive to borrow, fewer loans are going to be issued. And private banks create the amount of money that flows in the economy when they issue new loans. So that's the logic there. Behind it, they're saying because people will be borrowing less money, the overall economy will slow down, unemployment will increase, people will demand less wages, and they think that's what brings down inflation. In reality, it isn't all through the labor market. In reality, it's through everything else, because you can borrow money from a bank to do anything. Wow, I could have done 3 hours on this topic, not 1 hour on this topic. So there's lots that we haven't talked about in terms of the instability of this private banking system of ours, where we've given private banks the power to create money on their own terms. And that plays a crucial role on how the stock market and other financial markets are a source of instability, and how it affects all kinds of things, including our pensions. So there's more material in the slides that are posted. Lots of background discussion in the chapters. There's 3 chapters of the book that talk about finance and banking and pensions. And one other resource that we've put up, which is a little cartoon book called How to Make a Financial Souffle. A financial souffle. This is a funny little cartoon book that I worked on with my illustrator, Tony Biddle, that's also posted on the site, which is just an example of how speculative bubbles rise and speculative bubbles pop, and why we get the ups and downs in stock markets, in the price of Bitcoin, in other financial assets, and what they mean.